This episode is brought to you by Mortgage Workflow Partners and the Mastering Encompass series, both for users as well as administrators. You can find out all the information about it over at masteringencompass.com. Also, if you'd like to check out what we're doing on YouTube, go ahead and subscribe to the channel using the @MasteringEncompass handle. And make sure you stay up to date on all the information, not just with podcasts, but also video content that we bring to you as often as possible. Now let's get on to the episode. Hey everyone, Larry Bailey bringing you another read through of the weekly newsletter for what's going on in the market. We're going to go over what happened last week in review. Today is August 19th. We're going to be reviewing the week of August 12th in some details with some top stories. Before we go into that, please go ahead and hit the like button or subscribe to the channel for more information on this and all things Encompass, and just generally speaking, the mortgage market. If you're ever interested in finding out more, stay tuned for a lot of information here. So the first part of this is inflation has made some important progress lower, of course, in July, while home builder confidence and new construction slowed. We're going to go through all of these stories. The first story is consumer inflation falls below a key milestone. The next story is wholesale inflation cooperates and gives us a cool reading. The next story is home builders had mixed emotions. We're going to talk about that. Next story is housing starts slowed, signaling a tight inventory picture ahead. It's not necessarily good for a lot of reasons. The next story is retail sales hotter for the summer, and jobless claims dip lower. Now, this information, again, is brought to you from MBS Highway. I read through this, but I also give a lot of personal insights as far as why this is important. And that's why I do this, is to make sure you kind of hear beyond the story, not just what you're seeing on screen. If you're listening to this on podcast, that's awesome. Head over to our YouTube channel using Mastering Encompass. Or if you ever want to join the Mortgage.community, that's where we go over a lot of this information too. It's free to join, Mortgage.community. Check it out. So the first story is consumer inflation falls below key milestone. And on screen, you've got this great image of the Consumer Price Index, also known as CPI, and how that trend line has been angling down for some time. So the latest consumer price index, it's the CPI, showed more progress on inflation as consumer prices rose 2.9% for the first 12 months ending in July. This marked a slowing from June's 3% annual gain and the first time the CPL has fallen below that 3% mark since March of 2021. The core measure, that's the one that strips out the volatile food and energy prices, that increased 0.2% from June, while the annual reading declined from 3.3% to 3.2%. Shelter and motor vehicle insurance costs were the key reasons for this pricing pressure last seen last month, with the shelter component driving more than 90% of the monthly increase in all of the index items in there per the Bureau of Labor Statistics. Many other major items such as energy, new and used cars, and airline fares actually saw prices flat down in July. This suggests that most inflation has been quelled except for a few key areas that keep it artificially high. Bottom line of the story is cooling consumer inflation combined with signs that the economy and the job market are slowing have led to growing calls for the Fed to begin cutting their benchmark Fed funds rate, which is the overnight rate for banks to borrow money from the Federal Reserve. Currently, there are near certain odds that the Fed will cut rates in their next meeting on September 18th, though additional reports released between now and then will play a pivotal role on this decision. On the inflation front, Fed members want to see continued progress lower in the next personal consumption expenditures. That's the PCE. That's happening on August 30th, and the Consumer Price Index on September 11th. The Fed will also closely dissect the August jobs report. That's on September 6th. Further signs of labor sector weakness or rising unemployment, which could also impact the size of a potential cut. Next story is wholesale inflation cooperates with a cool reading. There was more positive news as the producer price index, which measures inflation on the wholesale level, that was also lower than expected in July. The headline PPI rose 0.1% from last month, with the annual reading falling from 2.7% all the way down to 2.2%. That's huge. Core PPI, which strips out volatile food and energy prices, was flat for the month, and year-over-year reading also saw a big drop from 3% to 2.4%. So personal commentary here. Remember that when we see wholesale PPI drop to flat, what comes next? The consumer. So that's going to be a big indicator. If we see that sucker drop or even flat or even slightly drop, this is more sign that the Federal Reserve has done its job and it's time to start cutting interest rates so we don't go into a recession. We don't want to go too slow, too fast, if that makes sense. What's the bottom line here, gang? Wholesale inflation was much cooler than economists had forecasted, and the bond market reacted favorably when the data was released Tuesday last week. The positive trajectory is important because some PPI components are factored into another consumer inflation measure called personal consumption expenditures. That's the PCE. We've talked about that for many, many weeks this year. And remember, that's the Fed's favored measure to figure out what's going on. So all this information bodes well for friendly PCE report when that's released on August 30th. We shall see. We don't know. We have to see what's going to happen. Here's the next story. This one's all about home builders having mixed emotions. Oh, come on, builders, just keep building. Pretty please? So on the screen, we see an NAHB, that's the National Association of Home Builder sentiment. You can see from March all the way down to August, it's gone from 51 down to 39. Let's get into this story. Confidence among home builders remains low, below the key break-even threshold of 50 per the National Association of Home Builders, the NAHB, as their housing market index dropped 2 more points to 39 in August. This marked the 4th consecutive monthly decline in the lowest reading since December, as higher rates, meaning mortgage rates, continue to dampen sentiment. I don't know about that. One bright spot, maybe affordability, but I don't know about dampening sentiment. One bright spot in this report was that the future sales expectations for the next 6 months rose by 1 point to 49. If they asked them now, I bet you it's probably at 60 because mortgage rates are at or near 6%, if not lower in some cases. We'll see. While still in contraction, builders expect lower interest rates will help boost demand in the next month. Scores over 50 on this index, which runs from 0 to 100, indicate that most builders feel confident about the current and near-term housing market outlook, whereas lower readings signify that there's less optimism among home builders. Bottom line of this story, gang, though all 3 index components, buyer traffic, current and future sales expectations remain below 50, the NAHB's chief economist, Robert Dietz, also noted that, quote, with current inflation data pointing to interest rate cuts from the Federal Reserve and mortgage rates down markedly in the second week of August, buyer interest and builder sentiment should improve in the months ahead, close quote. Robert, I just said that. All right, let's keep on going here, gang. Housing starts slowed, signaling a tight inventory picture ahead. What do you think happens when there's tight inventory and higher demand? I think I know this answer. Prices go up. So we see all about new home construction. Let's get into this story. Starts and permits fell again in July, with single-family units taking the largest hit. There's this oscillation between single and multi. Builders can't seem to figure this out. Single-family starts fell by 14% to 850,000 units from June. That's terribly under what's required to keep everybody housed properly and keep prices under control. My own personal opinion, of course. This points to a tighter supply for the foreseeable future, which would be supportive of higher home prices ahead. Yeah, no duh. Permits in the forward-looking indicator for new home inventory are only at 1.4 million, which is down from 4% from the previous month, showing that there are not as many new homes in the pipeline. There has also been a greater fallout of permits to starts than normal, meaning that not all these permits are going to turn into new construction. So what's the bottom line here? Softer than expected construction activity could limit the much-needed supply down the road, especially among single-family homes. This bodes well for appreciation and prices to go up, and shows that opportunity should remain to build wealth through home ownership. Well, not if people can't afford the home to start with. Sorry, I'm sounding a little sour, but that's just because I am. Next story is retail sales hotter for the summer. Retail sales rose 1% in July, above the 0.3% increase in the market was expecting. Sales in June were downwardly revised from 0 to negative 0.2%, which slightly tempers the July gain. The core reading, which gets plugged into the GDP, that's the gross domestic product, rose 0.3%, which was 0.2% above estimates. Sequentially, it has moderated from 0.9% increase in June, but this was also a beat and may lead to some other higher GDP estimates. Bottom line here, gang, is retail sales marks another report where the core reading came in above estimates, which may lead to stronger GDP estimates down the line. We'll see. Getting here towards the end here, jobless claims dipped lower. Initial jobless claims fell 7,000 in the latest week, with 227,000 people filing for unemployment benefits for the very first time. Continuing claims fell by 7,000 as 1.864 million people are continuing to receive benefits after filing their initial claim. Bottom line here is, though both and initial continuing claims fell last week, continuing claims are backing off their highest level in almost 3 years. This shows that once laid off, it's harder to get back to work. And yeah, it's damn hard. It's damn hard to get back to work if you get laid off. Hey guys, if you're interested in this family hack, it's around the 9-minute, 40-second mark. Check out the National Waffle Day happening August 24th. And there's a big recipe courtesy of the Food Networks that makes a delicious breakfast treat. If you like waffles, check it out. You can only get to that whether if you want to check out the video on YouTube or on mortgage.community. Here we go. What to look for this week. More housing reports are ahead, with July's existing and new home sales released on Thursday and Friday, respectively. The latest jobless claims will also be important to monitor on Thursday. Look for the Fed to make headlines when the minutes come from their July meetings are released on Wednesday. Investors will also be watching closely as economists, central bankers, and policymakers from around the world join the Fed for its Jackson Hole Economic Symposium, which starts on Thursday. And that's what's happening. My name's Larry Bailey. Thanks again. Please make sure you either like or subscribe to our channel here on YouTube using Mastering Encompass. We'll catch you on the next video. Take care.